All right, well, let's go ahead and get started. Thank you everyone for tuning in for another episode of the Sage Investor webinar. I'm your host, Jin, and I am joined by one of my partners from the Sage Investing Group, Lana Choi. For those of you who don't know us, we are former Big Four auditors turned multifamily syndicators. And our mission is to empower others like us in the accounting and financial industry to diversify their portfolio with cash flowing and appreciating assets such as apartments. So if you're interested in learning more about what is it that we do, you can go ahead and schedule a call with me on our website at thesageinvestinggroup.com. Now let's get started. Today, we are very excited to have Brandi Shotwell as our guest. Brandi, she is a principal at Reno Capital Management, which is based in Dallas, Texas. With over 20 years of experience in finance and real estate, Brandi has had leadership involvement in over $1 billion in real estate projects, ranging from commercial acquisitions to commercial development. So Brandi is obviously a powerful woman in this industry, and she is also our go-to mortgage broker. When we are underwriting deals, she is the one that we reach out to confirm our loan assumptions in our underwriting. And believe me, we go through many of these underwriting before we ever get to a deal that actually works. So we're always connecting with her. And when we do have a deal under contract, she works between us and the lender to essentially get our deals across the finish line, which is exactly what she did for us on our last closing that happened in this past September. So we could not be more grateful to know, to work, and to call Brandi our dear friend. Thank you so much for joining us today, Brandi.
Thank you guys for having me. It is such an honor to be here. You guys are rock stars, so.
You're so sweet. Thank you. Yeah, it was so good seeing you last weekend. We were just at a fire summit together last weekend, and it was so great seeing Brandi and her husband there. So yes. I know she's probably super busy coming back to work this week. So thank you so much.
Overwhelmed, but it will be okay. That's how conferences are, right? It's just like you get to connect with everyone, but then your emails kind of get left behind. So yes, it's all good.
Yes. I spent like 2 days when I came back catching up. So that was fun. Well, thank you. And let's see. So today we just want to make sure that we cover a few key questions that our investors have when it comes to the debt vehicles used in these multifamily syndications. We just want to give everybody a better understanding of what it's all about and maybe how it impacts the assets that you're investing in. So some of the questions that we're going to go through today are: what are the most common types of loans that are used by multifamily operators? In what situations are each type of debt used? What are some key questions that investors should ask the operators regarding the debt vehicle? So I'll go through these questions and maybe a few more here and there during our talk with Brandi today. And Brandi says she'll stick around afterwards as well to answer any of your questions at the end. Now, before we dive into this, Brandi, would you please tell our audience more about yourself and how you got involved in commercial real estate lending?
Yeah, absolutely. So I have been in the industry over 20 years. I've been financing property over 20 years. And the last almost 7, I've been in the commercial space. So prior to that, I was in the single family space. And I was just looking for a change. I wanted to get out and kind of expand and explore. And so I put my resume out there and I said, hey, let's see who picks it up because I want something different. And a company out of California reached out and they were like, oh, we would love to have you on our team. And I was so afraid, because I was like, oh, this is so different for me. And I don't know the terminology. I don't know the lingo, and I never want to sound ignorant. So I just did a lot of reading, a lot of studying, and they, put me through a training, and I was like, yes, I can do this now. So that is what catapulted me into the commercial real estate industry. And I think that's why I can relate to a lot of investors that are just starting, because I know how difficult it is coming from single family, because that's where most people are coming from, either single family or no experience whatsoever, right? And they're dealing with a lot of people who just try to make it so complicated, and they use this terminology that makes it so hard to understand. So just, I think that's where I relate with a lot of people on that end, on that front as well. But that is how I got started.
That's great. Yeah. I mean, that sounds very much to how we got started too in multifamily syndications. We stepped into it and it took a while for us to learn the lingo and kind of like how the whole
Yes,
process works. And I think you're an expertise in your field and you made the lending part of it so easy for us to understand and to, for us.
yeah,
So yeah, we really appreciate that. And that's a good thing about being an expert. So you can teach other people, break it down,
yes.
make it into simpler terms for other people
Right,
who are
exactly. And I
new.
make it so complicated, like, using
Yes.
this lingo that's, yeah. So yeah, I even have a section on my website that goes into like the ABCs, because the
Oh,
words
yes.
and yeah, it complicated. They make it so complicated.
Yeah,
Yeah.
no, you're right. I saw that section. I actually took a few of the definitions from there to put on my social
Yes.
media. So anyways.
Good. Good.
Well, that's great. Well, I know there's like so much that we can talk about with you, Brandy, because it is kind of a complicated subject. But I think today we do want to simplify things for our investors.
Okay.
And so, for the sake of time, I want to focus on essentially, I guess the talk about the most common types of loans that investors would see when they come across a multifamily syndication investment opportunity. What are those common loans that typically appears?
Yeah, so you have two different styles that are typically used. They're not the only, I want to make that clear. They're
Right.
not the only, but this is the most popular. You have your Fannie and Freddie, which is your agency loans, and then you have your bridge loans. And so, Fannie and Freddie is kind of in that same bucket. So we'll just call those agency loans.
Mm-hmm.
And then you have bridge loans, which is very, very popular, especially post COVID.
Mm-hmm.
So that is the most commonly used. Those are the most commonly used multifamily loans that you'll see
Mm-hmm.
when you're working with syndicators.
All right. So, in what situations would like an operator choose an agency loan over a bridge loan?
That's a good question. So usually, Fannie used to provide CapEx in the loan, and post COVID they don't do that any longer. And so on an agency loan, that property will be a stabilized property, and stabilized is a property that is 90% occupied for 90 days. It's a property that has good cash flow, because we have to be at a 1.25 debt service coverage in order to maximize the loan proceeds. And what investors should know is that anytime that you can take more debt than you do equity, the returns will be better. So it will be better for them if that operator can maximize the debt side versus maximizing the equity side. Now, there are certain, situations where that may not be true, but that's the general rule of thumb. So in an agency loan situation, we need a stabilized property. We need a property with good cash flow. And we need a little bit of extra time, because the agency loans take a little bit longer. Actually, bridge loans are taking longer too now, but that is a situation where you would see an agency loan be used. It's a fixed rate product. It's a long-term product. You have a 5, 10, 12, 15, year terms available. And so a lot of investors will use that in those situations where it's a stabilized property. And maybe they'll if they have a 5-year strategy, they may take a floater, or they may take a step down prepayment penalty. They come with these different prepayment penalties where you can kind of custom structure it around the business plan. But they are still good loans. The rates are amazing, depending on the terms, depending on the property and the location. You can still get in the twos, depending on the loan amount. So that is when you would use an agency loan. Now, there are some properties and that are stabilized, they have 90% for 90 days. They have a 1.25 debt service coverage, which means they have good cash flow, but maybe you have a rehab budget of $5,000 per door. And so if you can get that included in your debt where you can execute your plan, that is when you would choose the bridge side. So it's not always where, you take a bridge loan because a property is not stabilized or because a property does not have good cash flow. You may have a $10,000 per door rehab budget or $5,000 per door rehab budget, and you want to be able to get that included. And I've seen situations where the occupancy is there and the cash flow is not, right? So we have to decrease the loan amount in order to, and maybe you don't have any rehab. So say you have a scenario where you have a stabilized property, you have some cash flow, but you just don't have enough. And you were looking for a $5 million loan, but now you've got to take a $3.5 million loan because there's not enough cash flow. Well, that's a situation where you can use a bridge loan to maximize those proceeds until you can stabilize the property, meaning stabilize the cash flow, increase the cash flow, and then refinance out later. So bridge loans are amazing. A lot of people used to shy away from bridge loans in the past because they think bridge loan, they think hard money. But I think our last deal that we closed was like 3.8 or something like that on the interest rate. And so we can get really aggressive on the pricing for bridge. And when bridge pricing is just the same or lower than agency pricing, why not maximize those proceeds and maximize your returns?
Okay, that's great. I think a lot of our investors, well, not a lot, but like sometimes they would be a little bit more hesitant when it comes to bridge loan because it's not as common. They're not as familiar with it. All of us who have bought residential real estate, always use a fixed long-term loan, the agency loan in the commercial real estate world. And so when it comes to bridge loan, they kind of they feel a little bit scared by seeing it. And so, I mean, what are some risks, I guess, that you see between those two? Like when investors are looking at it and they're like, maybe trying to decide between, let's say that two assets are the same. Then, they're deciding between like maybe that one has an agency loan and one's getting the bridge loan. I guess what are some risks to either?
So your biggest risk with bridge loans and the syndicator that you're working with is how are they modeling that exit? And I think that's where a lot of passive investors get a little bit concerned. And I've seen it myself where that operator is being way too aggressive on the exit. The thing about the bridge loan is it does have to be refinanced or sold. So maybe you can get that longer, 3-year bridge loan or 2-year bridge loan, and then they have extension options built in. Obviously, an exit strategy is always to sell, but if the plan is to refinance as one of the exit strategies, you want to make sure that that operator, that syndicator is being conservative enough in their approach for the exit. Are they using a today's interest rate for a projection from 2 years from now? We don't want to see that, right? We want to see someone who's putting in some buffer in there and structuring the worst case scenario for the exit and giving us a realistic approach to the returns, because at the end of the day, we're all kind of using a crystal ball on where we think, the rate and the terms will be, 2 years from now or 3 years from now when that plan is done. But we want to make sure that those syndicators are being conservative in their approach and their assumptions for what their exit strategy is and what the plan is 2 or 3 years down the road. And I think that our passive investors are a lot more savvy than what they were 5 years ago. And which is great because they're being educated and they know and those are the investors you want to deal with, where they can say, hey, I think, maybe it should be this number or that number, or maybe ask more questions. So yeah, that is the biggest thing that I would say is the difference is, yes, here's a Fannie loan, but maybe the returns look better on this bridge. Well, what is that exit strategy? What is that syndicator proposing? And are they being conservative enough in their approach? And do they have multiple exit strategies, right? We know what some options are. I've had investors in the past take a 311 bridge loan. So they have a 3-year bridge loan. They don't have to keep it for 3 years, but they have a 3-year bridge loan with 2 1-year extension options. That's a 5-year loan, so hey, at the end of 5 years, if we can't make it work, we can sell, or the plan is to refinance in 18 months. But if rates are too high, we at the end of the day, we have 5 years. You know what I mean? So just knowing what those plans are and what those exit strategies are super important to passive investors.
Okay, that's so then you were mentioning how you want to make sure that it's underwritten conservatively, and so the projection, the interest rate, if they're projecting to refinance or to sell, what typically is like the increment in the in the interest rate that they should be using for that refinance?
So I typically recommend using 100 to 150 basis points higher than where current rates are today. And so, Jen, when I underwrite it, I'll say, okay, well, this is what I would use for now. And this is where rates are now. And this is where, I would use, so if rates are 3% today, maybe use 4.5 for your exit. It seems crazy to use 150 basis points higher, but I think that that's a good number. It's like, wow, well, we're using 150 basis points higher than where rates are today. And we've already heard from the feds that, that they're still, not raising rates for a while. And if they do, it'll be a very slow process. So I think when you consider the economic climate, 150 basis points is a very good number to use, higher than where the current rates are.
All right. So the 150 basis points, just to break it down by year. So let's say that, they're 1 year out, is that 50 basis point per year that you, until you refinance? Would that
yes,
be
that would be yes, absolutely. That would be a very good number.
Okay. 50 basis point increment per year.
Yes.
For when you're refinancing or when you're exiting the deal.
Correct.
Okay.
Correct.
That's great. And then I guess so it sounds to me like when there is a bridge loan involved, just making sure, obviously that there's multiple exit strategies and that they're being conservative in the rate that they're using for the refinance or the exit. And also that there are extension options available. So in case the business plan doesn't execute timely, maybe there are delays, like we incurred delays during COVID on many, of the renovation projects, then they have the option to exercise those extensions.
Correct. Okay. You want to make sure you have that. Yes.
And then every time they exercise an extension, I suppose does the rate, how does that impact the rate at that point?
So the rate does not move. Typically, most lenders will keep the rate the same, but they charge a fee. So you also want to make sure that syndicator is considering, okay, we're going to have a fee at every extension, and we do have that already built in. Every lender is different, but that extension could be as low as 0.25% to as high as 1% for an extension. Okay,
0.25%. That's great. All right, so I think you kind of answered my question about like what questions like investors should ask the operators. Yeah. So I think that was part of it.
So obviously those are the questions they should ask, but I always tell people the biggest thing is knowing who you're investing with, right? So know your syndicator, know who they are, make sure that you have synergy with them, that you trust them, that they've executed, on this same business plan before. That's more important to me than anything, is making sure you know that person, because obviously, these are non-recourse loans, but they do have bad boy carve outs. So you want to make sure that operator is someone that you trust first. and then ask the questions.
I can't agree more because debt is just one aspect of an investment, right? And if
Yeah.
you're working with experienced operators, then obviously they know what they're doing when it
Yes.
comes to selecting the debt that's most appropriate and most beneficial to that investment.
Yes.
So yes,
Yes.
100% I agree with
Absolutely.
you on that.
Yep.
Yeah. Great. And then so I guess another question I wanted to ask you on top of what I had was let me see. So, when lenders, you probably know this really, really well. So, when lenders underwrite deals, just to kind of get a perspective on the things that they look at, and maybe, as investors, we should keep in mind as well. So, when they underwrite deals, what are some of the key things that they look for to assess the risk of an asset? And then ultimately, like what terms to offer to the borrower on that asset?
So what they're looking for is, and this is just in order to get the best terms possible. So we're going to talk best case scenario.
Mhm.
So in a best case scenario, most lenders are going to look for an area that has a market that has a population of 100,000 or more. They are going to look for pretty good cash flow. We're looking for a debt yield, which is another cash flow calculation, but we're looking for a debt yield of 5% or higher. So that's not a stabilized number. That's just, hey, it has pretty sufficient cash flow where we don't need interest reserves. They are also looking for markets that do not have high military concentration or high student concentration. So anything over 20% can be a sticky situation. If it's an actual student market or if it's an actual military market, that's a different story. But when the markets rely heavily on the military or heavily on students, then that can be a higher risk for a lender, and maybe we would have to use an alternate type of financing for that. The other thing that they're looking for is headline risk. So what has happened at that property? Have there been any murders? Is there a lot of crime around there? That is typically, so when most investors are looking for that C-class value add property. And a lot of, unfortunately, those C-class value add properties sometimes have, crime around there. So that is another thing that can be a high risk item for a lender. So headline risk, market concentration, population, and cash flow. Those are four things that they're really looking for that will give you the best or worst terms.
Okay.
Yes.
Yes. And so I guess in terms of crime, obviously crime on the property is a big deal. And then typically how much, like, what's the perimeter, the radius that they look around the property, like within what perimeter do they look at?
Yeah, they'll so typically for something like that, they'll go like 5 miles around the property to kind of see what has happened in the area. And I've had properties where they didn't have anything on the property, but it was so much happening around the property that we still had to do a crime mitigation plan to make the lender feel comfortable with, lending on that property. But typically a 5-mile radius to see exactly what's going on in that particular market.
Okay. That's good to know.
Yeah.
And then I guess going back really quick to the agency loan, because I have a follow-up question on that. So I guess, it sounded like agency loans are more for stabilized assets. But what is the what is the cons of having an agency loan on an asset?
There really isn't a con to it.
Yeah.
The only the thing that sticks out the most for me is the prepayment penalty. And a lot of
Yeah, that's what I was
times
thinking.
investors, yeah, a lot of times investors have a hard time choosing. Every agency loan is going to have a prepayment penalty. I don't want to say every loan in commercial real estate, because you do have bank loans that don't have prepayment penalties, but most commercial loans are going to have a prepayment penalty. And so With a bridge loan, okay, that's a 1% or half a point or whatever, right? Exit fee. But on agency loan, it's like the prepayment penalty is like a stickler for some investors. And so to me, that's really the only downside, is making sure that you choose. And I wouldn't even call it a downside, but it's just choosing the right prepayment penalty for your business plan.
Mhm.
And, making sure. So if somebody tells me, hey, I've got a 5-year strategy, I'm typically going to tell them to take a 7-year loan, and then let's work out the prepayment penalty to where it's not as much, when they decide to exit. Because what if the plans change and they decide not to exit in year 5? Or maybe I'll tell them to take a 3-year loan where after 3 years or after 2 years, they don't have a prepayment penalty. It comes with a higher rate, but at least, if you sell in year 5 or year 6 or year 7, you don't have a prepayment penalty. So to me, that is the hard part with the agency, is just making sure that you structure your prepayment penalty according to your business plan.
Okay.
Yeah.
Yeah, that's good to know. Yeah. Yeah, because we've encountered like certain investments where the penalty was quite high. So it kind of
Yes.
took a hit on the returns at the end of the day when they exited
Yes.
before
And
the term was
for
up.
yourself, because I think you've
Mhm.
looked at some properties. I know you've looked at properties where it had an assumption, and it's like, we had to do this assumption because the prepayment penalty was so high for the seller, that it didn't make sense for the buyer to take out new debt because, there's a $2 million prepayment penalty on it. Yeah.
Yeah.
And just to add something to that, because to what Brandi was saying, a lot of times when we're looking at deals that have a loan assumption, because the prepayment penalty is so high for the seller, they'll actually offer the price on a per door base, or basically overall price, much lower than
Yeah.
if it was going to be accepted with brand new debt that you would place on it. And the reason why is because they're saying, we'll offer you at a discounted rate because you're also assuming my loan, and therefore you're taking the burden of having to pay the penalty off my shoulders.
Yep.
So something to also consider is sometimes we'll see things traded at a lower than market price of a property, but it's because underlying there's an loan assumption being taken on.
Correct. Yep. That is true.
Cool. Thank you so much for adding that in, Lana. And so, yeah, she's the one doing most of the underwriting. So she knows, this type of situations inside and out. If you guys have any questions, we're opening up to questions from our audience now. Does anyone have any pressing questions that they want to ask Brandi while we have her here today? Maybe we'll give people a minute to think about it.
Maybe while we're waiting, some questions that I had when I first started doing this, maybe to cover it. So going back to the crime thing, I know you mentioned whether it's at the property or maybe the property is doing well, but the surrounding area has something crime. And you mentioned that maybe it's just putting in a remediation plan. Can you talk about what some of the remediation items could be or could look like in
Yeah,
the letter?
absolutely. One of the main things we always like to see is if the property does not have any gates. Now you can't gate every property because maybe it would not be cost effective, right? Or maybe you have way too many entrances to have them gated. But gates is one of the first things that always come up. The second thing would be lighting and cameras, because that's super important. Anytime a property is well lit and you have cameras in, it is going to decrease the crime. Another popular remediation item is having an on-site officer stay at the property and offer him a discount on rent. Anytime outsiders or even tenants see a police car in the lot, it's either going to deter the crime and it's also going to make the residents feel safe. So those are typically the 4 most popular, other than keeping the area clean, making sure there's no graffiti, and keeping the landscaping down to where, you can't have people hiding behind large bushes and things of that nature. But those are the most popular thing: your gates, your lighting, your cameras, and the on-site officer. Yes.
All right. Does anyone else have any other questions? Brandi, how many lenders do you typically work with?
Oh gosh. So I have hundreds of lenders that I work with, but I don't work with all of them. I have like my favorite 10 to 15
Mhm.
that I typically work with. I like to keep my volume high working with those lenders. You know, you consistently work with the same lenders. You can, you know, get things done outside of the norm, you know, and typically, you know, get good customer service and build those relationships, like how we build relationships with our clients and we build relationships with our investors. I also have to build those relationships with the lenders. And that's super, super important. Yeah.
Okay.
So typically I call them like my fab 10, 15 lenders that I like to work with. Yeah.
Yeah, this is a very relationship-based business.
Exactly,
Yes.
exactly. And you know, how they perform after closing, you know, that's super important to me. So getting a loan closed is easy, but how they service it is even more important to me. You know, having that relationship, I stay involved after. So if you need me and things go awry, I need to know, because I need to know, you know, I need to make sure that they're doing what they're supposed to do after closing.
Yeah, you're right. And that's why it's like so important to have a good relationship with you. And, you know, we love knowing you personally as well as professionally, because we know that you will back us up. You know, you'll definitely help us out to get the deal across the finish line. And then afterwards to maintain that relationship to make sure that, you know, we're getting our needs being met by the lender after the closing, because we do depend on them to give us a draw. Right.
Yes.
To keep
Right.
the
We
cash
can't have
flowing
them
going.
being slow or delayed. Yes.
Yes,
Correct.
exactly. So,
Yeah.
Yeah, that's
so
something new that I learned about commercial lending, is that lenders are just as involved as any other partner on this deal, even after
Yes.
close. They will have their own asset manager that
Yeah.
monitors the performance of the property alongside the asset manager, you know, equity asset manager for the partners, right? For the sponsorship team. And that's something that was novel to me, because, you know, you think of residential loans, like they're not really so involved once the property closes.
that
The
sounds
deal
like
is
pay your
you
mortgage
pay your
payment.
mortgages and you're fine, right? But
Yes.
no, in this case,
Yep.
it's not. They want to know what's going on every step of your renovation project. They want to know, okay, how is that property performing? And so, you know, your investors are your equity investors, who are, you know, people investing in your deal, but also your lenders who are also there with you side by side. And that's something, and Brandi being there, super helpful, because Brandi, you're literally there from the very beginning to the like pre-acquisition, when we're underwriting deals. We get your help on where should we place these numbers, where the lending terms coming out today, and then all the way through once we're putting in our offer, just tightening up those loan terms, all the way through the closing process, getting our lender in place, and then through closing, we're still with you. So you're there through and through.
Yes.
Truly, Brandi's there.
And so we have a question here from Bach, and he said, are there any state-specific restrictions by lenders?
Not necessarily state restrictions, but certain markets across the US, not necessarily by state, may be looked at as soft, you know, where they were on the agency side, where they'll say, okay, well, we're not going to lend over 65% in this particular market, or we're going to require you to use a higher debt service coverage ratio. That property needs to have more cash flow if it's in a smaller market or a tertiary market. So it just depends, but not any state specific requirements.
Thank you. All right. I mean, I think we are up on time for the webinar today. Brandi, how can our audience get in touch with you if they have other questions?
So the easiest way would be to go to my website at renocm.com, and there you have email and phone number, and then social media platforms to connect with me as well. So you can add me on LinkedIn, Facebook, Instagram, all that good stuff.
Yep. Thank you, Lana. She put your website in the chat box, so you guys can click on it there. Yeah, thank you so much for your time today, Brandi.
Thank you guys for having me. It was awesome being here.
Yeah, thank you so much, and good luck to you and your hundreds of closing coming up. So.
I know. It's going to be a hectic end of year, but we'll get there. So I see Nathalie on here and Jules. Hey, girls.
You know them.
Those are my girls. Yes, yes, yes. Hello. All right. Yes,
All
it
right.
was a
Thank you,
pleasure being
guys.
on. Thank you so much.
All right. Thank you so much
Thank
for
you,
your time.
Brandi.
Take care,
Okay.
everyone.
Bye-bye.
All right. Bye-bye.